Hi, and welcome to this week's market presentation. Latest news.
Russia successfully delivered LNG to China through its Arctic LNG 2 terminal in the northern parts of Russia. This marks a new avenue for Russian gas exports to other countries, particularly Asian consumers, and it certainly will be a challenge towards the existing sanction regime imposed by the European Union and the US against Russia. The prospect of an increase in global LNG exports has added some better sentiment to gas markets, although it remains to be seen how productive the facility will be and how much it will impact overall LNG flows globally. In other news, Indian Prime Minister Modi met with Xi Jinping and Vladimir Putin as all three countries continue to negotiate and discuss their ongoing economic relations. India and China have agreed that they are partners in development and not rivals, reducing the tensions that have been rising between both countries over the past few years. Additionally, Chinese President Xi Jinping advanced his vision for a new global order centered on, quote, the global south, in opposition to the US and the European Union in particular.
Weather.
Moving on to the weather forecast, temperatures across most of Europe are expected to increase over the coming week to above average across most of the continent. Over in Central and Eastern Europe, temperatures are already above average and are expected to remain so over the next 7 to 10 days. In terms of precipitation, we're going to see less precipitation than we had over the past week, particularly over in the Nordic region, with just a bit of rain over the beginning of this week. Then in terms of wind speeds, we're expecting to see wind speeds pared down over the course of the next 7 to 10 days, potentially weighing on future wind power generation. And lastly, looking at the hurricane tracker, we note limited activity in the Atlantic as we continue to move through a quite uneventful hurricane season so far.
Macroeconomics.
In the latest PMI macroeconomic figures released for the month of August, we saw Euro area manufacturing PMI increasing above the 50-point level to 50.7 over the past month. Elsewhere in China, we saw a pretty stable situation with both the National Bureau of Statistics and the Caixin Index showing relatively limited movement up or down over the past month. Over in the service industry, we see a slight deterioration in the Euro area down to 50.7, but still showing growth in the overall services industry, helping maintain economic growth stable across the Euro area.
Crude oil and LPG.
Moving on to crude oil markets, we see a pretty stable price evolution over the past week with quite limited movements. The front month for WTI prices moved up by just 0.6%, with Brent crude oil moving up slightly more than 1.3%. The frontier, on the other hand, saw relatively small movements with prices moving less than 0.3% for both indexes. Looking at the supply and demand conditions and its outlook, we see a mixing fundamentals. On the demand side of things, the prospect of an interest rate cut by the Federal Reserve in September is increasing some demand expectations from the US, while at the same time, the growing signs of the slowing of the US economy is adding some concerns over that future growth. Over in the supply side of things, as the US imposes tariffs on India, as it tries to get India to stop purchasing as much Russian crude oil, which could limit global supplies. We are seeing OPEC Plus continuing its production rate increases, helping to stabilize the supply outlook. Overall, the outlook remains unchanged over the past week, with expectations of an oversupplied oil market over the coming 12 months.
Natural gas.
Moving on to natural gas prices, we saw a bearish price evolution, particularly in the shorter term. The last quarter of 2025 saw a decrease of 6% week over week, with the front year coming down 4.3% on the week. Further along the curve, the decreases become much more modest, with 2027 down just 2.3% and 2028 down less than half a percentage point over the past week. Looking at the fundamental, storage levels continue to increase over the past week, although at a slower pace as the rate of injections decreased week over week. Overall, the rate of injections remains in line with the average since 2012, but has slowed down over the last few weeks compared to the highs that we saw earlier in the summer. The slower rate of injections continues to keep the storage deficit versus the previous year quite elevated, with the last storage levels of the past week at still 16% below last year's levels. This is raising some concerns over the level of storages across Europe for the upcoming winter, and overall is leading to some additional upward pressure on the market. Moving on to total supply and demand, we've seen an uptick in total demand across Europe, in part driven by the weather conditions over the past week, while at the same time total supply has eased slightly week over week as Norwegian gas maintenance continues on schedule, with overall demand and supply at the lower end of the range over the past 5 years. Looking at the European supply mix, we see that decrease in those Norwegian gas flows as maintenance is reducing flows towards Europe. So far, flows from Norway remain in line with the past 5-year average and in line with the decreases we've seen in previous years. So far, this maintenance is going according to schedule, and there have been no additional maintenance needs being announced. But as we move through the height of the maintenance season, we'll certainly see any changes to that affect the prices across Europe. Over to LNG sendouts, we see those have stabilized over the past weeks, but when we look at LNG imports into Europe, we see those have continued to decline week over week. Now, the decline in LNG imports at this time of year is in line with previous years and in line with the seasonality of European LNG demand. Nonetheless, the higher and warmer temperatures we see across Northeast Asia is leading to additional demand from that region, which is adding to the decrease in the amount of LNG going to European consumers. Looking at these investment fund positions, we've seen the level of net long positions decrease over the past weeks quite steadily. Part of the factor here is the continued uncertainty over on the economic side of things and how the demand will evolve in the coming months and year.
Coal.
Moving on to coal prices. Coal prices came down over the past week in line with the bearish price evolution we saw in natural gas markets week over week. The API2 index for the front year came down 3.4% on the week, with coal prices in Asia seeing slightly lower decreases of just 1.6% on the week, but nonetheless following recent bearish price evolution. In terms of global demand for coal, we are seeing some added demand in Northeast Asia due to those warmer temperatures increasing demand from the power sector, while at the same time coal stocks, particularly in India, are remaining comfortable for this time of year, reducing some demand for imports there. On the supply side of things, certainly the reduction in domestic production in China is adding to some additional demand from China as total supply has taken a bit of a dip lately. Over in Europe, coal stocks at ARA terminals remained near multi-year lows for this time of year, although given current demand for coal are more adequate than one might think. Nonetheless, as we exit the summer with the stronger power sector demand as we move into the fall, the expectation of a decrease in overall coal consumption in Europe is also weighing on the market.
EU and UK emission allowances.
Moving on to European allowances, we see pretty small movement when it comes to the European market, with prices decreasing less than 1% on the week. But nonetheless, we've seen a steady increase over the past few weeks, with prices roughly 3% higher than a month ago. Over on the UK side of things, we saw prices increase by around 2% over the past week and have now shown to be, for the December 25 product, just over 6% higher than a month ago. As we near the compliance deadline of September 30th for the European market, we're certainly seeing that add to the overall buying demand and resulting in a little tighter market conditions leading up to that deadline. At the same time, the ongoing geopolitical tensions in Europe as the war in Ukraine continues with no near end in sight, also adding to the volatility and some of the upward pressure we see there. On the other hand, when we look at power sector emissions so far this year, those have remained near the lower end over the past 5 years, and the uncertain economic outlook with some weaker growth now forecasted for the euro area potentially weighing on future demand expectations. Looking more closely at those power sector emissions, we see those that, while have ticked up over the past week in line with the increase in gas consumption as well, in part from the power sector, we are seeing those emissions at the lowest level over the past 5 years, signaling a continued weakness in the overall emissions demand. Over in the investment fund positions, we've seen those as increasing slightly week over week. Part of the increase here was certainly the disappointment regarding the peace summit to end the war in Ukraine, with the prospect of an end to hostilities appearing further away than previously anticipated, which in turn is leading to that geopolitical risk premium being added to the market, with those net long positions holding a little more weight over the past weeks.
Electricity.
Moving on to electricity markets, we see a similar evolution as we saw with natural gas, with prices decreasing over the past week, particularly in the shorter term, the last quarter of 2025 decreasing by 2%, with the front year down 2.2% on the week. This slight increase in current prices is certainly limiting some of the downside electricity prices as opposed to the natural gas price evolution. In terms of the price evolution across other European countries, we see a similar trend there, with prices decreasing over the past week for the front year, very much in line with the evolution we've seen in previous weeks. Over in the Nordics, on the other hand, particularly when we look at those prices in Norway and in Sweden, we actually see a further increase over the past week, and a big part of that is the poor precipitation forecast, which are leading to more concerns over the hydrological balance in the region, worsening the hydropower outlook there, which, given the dependency on hydropower for the power mix in the Nordics, is adding upward pressure to the market. In terms of total demand and residual load, we see an uptick in both total demand and residual load there, while still pointing out the fact that they remain at the bottom of the range over the past 5 years. In terms of the European supply mix, we still see both an uptick in solar and nuclear over the past 100 days, indicating the improvements, particularly in the French nuclear power output, and also the record levels of solar power generation we've seen, particularly this summer. On the other hand, the somewhat underwhelming wind and hydropower generation still led to an increase in the share of gas and coal. Over the past week, French nuclear power generation has remained relatively stable week over week, near the top of the range over the past 5 years, in what has been a positive turn of events. In terms of renewables and fossil fuels, we see a slight decrease in renewable power generation week over week, falling below the last year's levels for this time of year, and that difference has then been made up by an increase in fossil generation, given the increase in total demand for electricity in Europe. In terms of renewable power generation, we see that decrease is particularly in wind and also in solar. Wind power generation now in line with the average over the past 5 years, and while solar has decreased week over week, it's still at a record high for this time of year. In terms of fossil fuel power generation, we see that uptick most notably seen in fossil gas generation, in line with the increases we saw last year, but overall fossil gas generation still remaining near the bottom of the range over the past 5 years. Lastly, when we look at hydro reservoir levels here, we see what is adding some upward pressure to the Nordic region, where the hydro storage levels were from a pretty significant excess versus the average since 2015 earlier in the year, which has then continued to narrow over the last couple of months, particularly in Norway, which is now just 1% above the average. And given the drier weather outlook, the prospect has certainly worsened, and as a result, we are seeing those tighter prices in the Nordic region. And lastly, looking at guarantees of origin over the past week for the year of production 2025, we've seen a continuation of the bearishness that we saw week over week, with prices decreasing noticeably. Looking then to 2026, while we did see prices come down over the past week for most technologies, and we see an overall bearish price evolution, we're seeing a little less downside then compared to 2025. And we see a similar trend further along the curve, with prices for 27 and 28 increasing over the past week. The greater bullish pressure in the market as we move further along the curve, very much driven by the greater demand expectations for those years for guarantees of origin, as well as some uncertainty over the expected growth in renewable energy capacity. For 2025, on the other hand, we've seen that pretty adequate levels of renewable production, with particularly solar at record highs so far this year. As a result, we've seen that add some of the bearish pressure on the market. But nonetheless, seeing quite a bit more movement really throughout this summer than we saw throughout much of 2025. That covers this week's market presentation. Thank you for joining.